I want to skip it all and get straight to the panel with Erin, Browne, Sankaran and Jay Pelosky. And Jay, come to you on this. The underperformance in information technology, the outperformance in the banks, energy, materials on my screen this morning up 0.5%, Jay. It's an early move. It's a flavour of 22 maybe. What is it for you?
Yeah, well, it's nice to see, John, because the last 6 or 9 months have been pretty rough. I mean, all these things peaked back in the spring, right? And we've had what I call a twin engine market, right? When rates go down, growth does well. When rates go up, value does well. We've had a little bit of a rate backup. I think pricing and the fact that Omicron's not going to be very negative for growth. It's actually been a move in real yields, not that's been driving this. And so to me, I mean, we're positioned for this. As you know, we've been a big believer in the cyclical value trade, big believer in non-U.S. equity, big believer in small caps. And I think we've got plenty of room to run. If we have the kind of growth that I expect, again, above average growth, above trend, but declining inflation, that's room for commodities to do well. If we're at peak Fed hawkishness, that means the dollar can roll over. That's good for commodities, good for non-U.S., good for cyclical, good for value. And history suggests, John, XLE, the energy ETF, was up 3% 2 days in a row. It's done that 18 times before. In the 17 of the 18 times in the next 1 month, it's been up 7%. So the odds are pretty good that we're going to have at least a continuation of this through Q4 earnings. And these segments have a lot of room to run. Any chart you want to pull up of 5-year history, 10-year history of growth versus value, value has been absolutely decimated. Non-U.S. decimated versus U.S. This could go on. If it's the real turn, it could go on for years.
Energy right now at 1%, financials at 0.4%. Sri, Jay's used that term a couple of times now. I want your view on it. Peak Fed hawkishness before they've even fired a bullet. Sri, really? Your view?
Disagree. I mean, we think that it's kind of still some way away from realizing where the Fed's peak hawkishness is going to be. Clearly, the market's kind of pricing in a bit more of the Fed hawkishness now, but I do think that we are somewhat in uncharted territory with respect to how quickly inflation comes off. And to that extent, I mean, the way we're framing it is that we probably do have to see some degree of hawkishness in the tone with respect to the pace of balance sheet reduction and the market response to that. It's not clear to that that's almost entirely in the price. So that does have a bearing both in terms of the directional view and in terms of our sector calls, both within credit and in equities.
The sector churn right now, fascinating. Information technology down more than 1%. Energy, as I say, up more than 1%. The index overall not doing much at all, down 0.2%. Here's the view from Bank of America. A quote for January. January is typically the seasonally strongest month for U.S. equity flows, with financials seeing the biggest average of the 11 sectors. Energy and industrials have also notably seen positive average inflows this month, while negative flows for all other months. I want to come to you on this, Erin, Browne. Just this view on this big churn we're seeing for the first 3 days, the first 3 trading sessions of 22.
Yeah, so first, I would never extrapolate too much from trading flows that you're seeing in January into the rest of the year. Typically, you see January be a month of reversal. So whatever worked really well into the end of the prior year, you usually see a little bit of a reversal in early January. And I think that's what we're seeing now. Certainly, the yield curve steepening is helping the value segment of the equity market. And I would expect that if you continue to see a little bit of a steepening of the curve from here, you will see value outperform and growth, which is considered a longer duration equity asset, underperform. But I think as we move through the course of this year, I wouldn't bet against technology. I do think that taking a barbell approach to the way that you're investing, so being long, segments of the tech market on one part of your portfolio, and then also being long select cyclical sectors that have underperformed and are, relatively well set up for the duration of this year, probably is the best portfolio construction. But I do think that in this environment where there is going to be higher volatility, there is going to be more uncertainty, tech, I think, will continue to do well in that environment. And so I really wouldn't read too much into the first few trading days of the year.
Well, on the first 3 trading days of the year, 2+ today. Let's get to Abby for a little bit more. Hey, Abby.
Hey, John. Yeah, let's give a little color to what we're talking about relative to this rotation. And it's pretty profound. Over the last 3 trading days, there is a wide spread between value and growth. In fact, the largest going back to 1995. The Russell 1000 Value Index over the last 3 days up 1.7%. Growth, on the other hand, down 1.3%. So as this trading day has gotten going, the spread is even wider. So folks really going into that value and cyclical trade. Not surprisingly, the NASDAQ 100 yesterday having a very rough day. Today, once again, down more than 1%, or down almost 1%, excuse me. But yesterday, the spread between value to growth, that NASDAQ 100, a spread of 2.3%, the worst, the second worst since May. So again, this rotation is very strong. As for what's working, not surprisingly, it's all about energy, financials, and industrials. Very interesting. Last year, the top sector was energy. We also had the financials in there. We also had tech. Often you'll see that flip on the new year as the year progresses. But right now, last year's top sectors, they are outperforming again.
Abby, thank you. In many ways, we're having the same conversation. Again, Q1 22, the same conversation as Q1 21, Q1 2020, Q1 2019. Is it time for active management? And then what do you see in the market, the index level, delivering double-digit gains? Can I come to you on that, Jay? Is it time for active management when the index has done so well for 3 straight years? In fact, make it more than that, but you know where I'm going. 3 straight years of double-digit gains.
Well, it certainly will be, John, if this year we see this move carry through, right? The last couple of years, as you mentioned, the move was not sustained because of Omicron and Delta and COVID not going away. If we're moving from pandemic to endemic, then I think the chances of this being sustained is quite significant. And look, I would, from a global macro asset allocation perspective, my outlook for 2021 was entitled The Golden Age for Asset Allocation. And last year was a fantastic year for global macro, if you got it right. Commodities were up 40%. Bonds had one of the worst years in the last 50 years. Global equities were up 20%. So active stock picking, I think, is a challenge and will continue to be a challenge because the way of market structure. But from a global asset allocation, global macro ETF-based approach, I think the opportunities are just fantastic, both in the U.S., growth versus value, non-U.S. versus U.S., in the thematic space where you know we're very focused on clean energy, on climate, things of this nature. And then I think the really big, interesting question, John, is whether we're at the beginning or the end of a bear market for things like ARC and innovation and disruption. Those things have been blasted. I'm in the camp we're at the beginning of a new upcycle. A lot of people disagree with that. I think that's going to be one of the really interesting things to watch in terms of alpha generation for 2022 and beyond.
Jay, that thought is interesting to me because given everything else you've just said over the last 38 minutes or so, that's not where I'd expect you to be. Some of those US big growth tech names, as opposed to the conversation we've had about international, Japan, Europe, China.
Well, I think, look, I mean, real yields are going to be the key here. I don't think we talk enough about real yields. Real yields, even after if the Fed does everything the dot plots say, real yields are still going to be negative. So I expect big cap tech in the U.S. to be an underperformer. It underperformed versus energy in 2021. Energy almost doubled the tech performance last year. No one talks about it. But where I see tech is as an anchor to U.S. performance. The markets that don't have big tech will outperform. The ARC type stuff I'm talking about, John, are not the big cap tech names. Many of them are not in the indices, and they've been trashed, and that's why no one pays attention to them. I think there could be an opportunity there. These things are down 30, 40, 50%. And if I'm right that as we go out of COVID, we enter this age of speed and an age of disruption, and we actually see how much has changed and will change in the years ahead, I think that gives that segment of the market an opportunity. And if you're looking for alpha, that's where I think you could probably find it over the course of 2022 and 2023.
Erin, this is seasonal. It's that time of the year where I ask active managers the importance of active management. Can we talk about the importance of active management as an active manager? Erin, how important is that going to be this year?
So this is something that Jay and I actually agree on. I think, many of the comments that he just made, I actually concur entirely. I think that active management is important and can generate consistent alpha if you pick your spots correctly. I think that we've seen equity, sort of equity stock picking be challenged over the last decade or so, but we have been able to see in select pockets of the market, like asset allocation, like bond investing, like international equities as well, consistent outperformance from and the ability to generate alpha from active management. And so I think that if done properly and if managers are selected correctly, I think active management can generate significant alpha for investors.
Sri, I want to finish exclusively with you on the credit side of this story. And if you want to, please weigh in on the active versus passive story, because from a credit perspective, it's different. Sri, as you've pointed out, the downgrade and default forecast from you and the team at Morgan Stanley remain really, really muted. The earnings outlook has been fantastic. Leverage has come down because of it. But Sri, I want to understand from your standpoint whether these corporations, these C-suites, the companies you follow every day, can remain as disciplined as they have over the last year.
I mean, to some extent, I do think that the discipline will remain intact. It is going to be a slower unwind into the more aggressive phase of the cycle. But at the same time, I think the one thing which does strike us in the context of credit markets, John, is the fact that, well, you're not really getting paid to make that more aggressive or bullish bet. But spreads where they are and the magnitude of compression that we have seen through the course of 21, I do think that this is going to be, 2021 was much more about buying beta and getting the directional call right. 22 will be much more about timing markets, being a bit more nuanced and getting the credit selection right. So to the earlier debate, I do think that there is going to be more value add through active management on the credit side as well. And more specifically, we do think that there's probably a bit of decompression that needs to kick in. And the lower quality growth sensitive pockets within the high yield market probably need to decompress a little bit before you can say that, well, the fundamentals are by and large more reasonably in the price. Right now, it's almost as if valuations are leading the fundamentals as things stand now.